Welcome to PhillipCapital's weekly Market Watch. The STI has seen a new low last week, so today we have Ms. Magdalene Chong, CFD dealer from Phillip Securities, to share with us her view on what's happening in the market now. So Magdalene, could you give us a recap on what has happened in the local equity market?
Well, two things to highlight here is we see Dow Jones, S&P and FTSE making a new low, whereas the regional indices like Hang Seng, Shanghai and Nikkei, they're trading off their lows. So we see the correlation for STI, which has also made a new low. It tends to correlate better with Dow Jones versus its regional counterparts. Secondly, it's when we compare our STI October low versus the way that it made its new low, I think the momentum on the way it's made the new low is a little bit different. For October low, it was a lot of panic selling whereby investors practically dumped the shares to 1473, and then after that it sharply rebounded back above 1005. But for this new low which we made in March, what happened was since the turn of year 2009, it was a lot of gradual sell down, and then subsequently touched 1456, and even then when it closed, it closed around this area. Okay, I think the psychological impact behind the way this new low is formed is such that investors are probably no longer in denial, and they are pricing in the worsening fundamental changes for the economy.
We heard that there could be some changes in the rules in the US. Could you give us some updates on it?
I think one of the rules will be to implement the short selling rule again, whereby investors will not be able to short sell on the financial counters. I think this will help to stabilize the share prices, especially for financial counters. Second rule, which I think they want to do, is to modify or suspend the rule to mark the assets to market. So right now, banks are marking the assets to the market, but the banking industry has written down billions of assets because of its illiquidity. If you implement this rule, the short-term implication will be that the balance sheet will stabilize because losses will not be taken to the income statements. At the same time, banks will not need capital injection to keep up with their capital adequacy ratios or for debt covenants. But I think the problem with implementing this rule will be that I think banks will be able to conceal their losses. The asset is actually worthless, but they're still keeping it as an asset in the balance sheet. And I think given the recent credibility that we see from the top financial people, I don't think it's a good thing for the shareholders.
What do you think is the outlook for our markets then?
Well, considering that the measured way in which our market has fallen, I think don't be surprised if it continues to edge lower. Also, I think the recent rally was due to two events. One was, I think the Citibank CEO came out to say that the bank has been making profits for the first 2 months of the year. All right, and retail sales was better than forecasted. I think what I would like to highlight here is unemployment figures are still very bad. So how can retail sales continue to go up if people are still losing their jobs? And as for the profitability of Citibank, it still remains to be seen whether can they be profitable for the whole of year 2009. All right, and if you look at technical analysis perspective, the main trend in the market is still down, and there's no fundamental changes that point to an upside for our market.
With all the doom and gloom you've mentioned, are there any bright spots?
Well, they always say that things has to get worse before it gets better. And I think market always turns around when the sentiment is at its bleakest. So let's say, you look at Warren Buffett himself, he actually started buying assets in the October low. And even though his own company, Berkshire, has fallen by 50%, he is still acquiring assets. So if let's say you're a long-term investor, so you're not afraid of fluctuations in your asset values, and you're worried that this could really be the bottom, I think you could pick up some good shares. I mean, there are some good bargains out there in the market right now. Sectors you could look into, perhaps the telco with high dividend yields. Two other sectors that I think I would advise you to avoid will be, I think, the China counters, because I think some of them have recently been plagued with accounting fraud. Another sector will be, I think, the banking counters. Maybe not for now, because they're still making their daily, they're still making their 52-week lows.
Before we end off, is there anything else you'd like to add on?
Well, I think not to end things a little bit too gloomy, I think we take historical perspective as an example. You look at the Great Depression, it started from 1930 to 1932. it didn't last more than 2 years. Our financial crisis in 1997 didn't last more than 2 years. So assuming that, you know, our market started sliding in October 06, and that is the beginning of our current bearish times, well, you know, you could actually see recovery maybe, say this year, 4th quarter, or perhaps beginning of next year. Okay, that's perhaps could be a bit optimistic, but the possibility may be there, right? And again, you know, we come back and look at the correlation of Singapore versus the regional markets. I think the lack of correlation doesn't really make much of a sense here, because Singapore is placed within the region. It will benefit from collective growth in the region. And the fact that Singapore has one of the lowest PE for a developed country and the lowest PE in Asia itself will simply mean that one day investors will look at Singapore and know that it's been oversold. And our market could sharply rebound from there onwards.
Thank you, Magdalene. That's all we have for you today. Please tune in next week for more market updates.